Now friends, let us start with the next concept, that is the matching principle. As far as the accounting is concerned, what is the matching principle? This question comes in mind. It is nothing but it is the basis for recording expenses. In accounting we need to record the transactions, so it is nothing but matching principle. It is the basis. Here the word basis is being used, so basis is used for recording principles, basis for recording expenses, it is the basis. Now here expenses are recorded. Expenses are the cost of assets which are increased in liabilities and which are incurred in earning of revenues. So expenses are nothing but the cost of assets and increase in liabilities which are incurred in earning of revenues. And second part is expenses are also recognized when the benefit from the expense is received. So expenses are basically when they are recognized when the benefit from the expenses is being received. Now how the matching principle works will show here. First, you want to know that it is nothing but it is the basis for recording the expenses, and there are two steps. First step, we need to identify the expenses which are incurred during the accounting period. First we need to identify that. Second, we need to measure the expenses and match that expenses against the revenues earned. So these are two steps. First we need to identify what kind of expenses are incurred during that period, and second we have to measure that expenses which are earned. Here for example the revenue part is there, and here the expenses are there. So revenue minus expenses will give you nothing but net income. So for example, if 100 rupees is revenue and expenses is 80, then you will see 20 rupees is nothing but the net income. So here matching principle is being used. For example, if revenues are 100 rupees and the expenses is 120 rupees, then you will see 20 rupees net loss is there. So this is nothing but the loss. So here matching principle will be used. For example, we'll see the matching expenses with the revenues. For example, if the revenue is rupees 8,000 and the cost of goods sold is 8,000, so the net income is 7,000. The goods were of 8,000 and we made the profit of 7,000, and we got the value how much, 15,000 from the customer. So this 7,000 is nothing but the net income. So let us begin with the next topic, that is accounting period concept, in the next video to come.